Wow, 9.1%. That was the US inflation number that we got yesterday for June, and it's safe to say that it took the market by surprise. The figure for May was 8.6%, and the expectation for yesterday's announcement was 8.8%. Not many people were saying 9, but number just keep going up, and this means that inflation in the US is now at a 4-decade high. Let that sink in. No, it doesn't feel good, does it? Now, of course, that's if you even believe that these official numbers have any grounding in reality. That's because for many around the world, inflation already feels a lot worse than that. Now, I actually did a video on the sham that is the CPI over on our main channel, which I'll leave linked to below. Now, whatever the inflation number for the US really is, we're living through some pretty unprecedented times. On the immediate release of these numbers, markets tanked. That's because they know what lies around the bend: more aggressive rate hikes. Prior to the release of yesterday's inflation numbers, the markets were pricing in a 50 to 75 basis point hike when the Fed meets later this month. That number has now also gone up. The Fed's watch tool, which uses interest rate futures, has a 75% probability of a 100 basis point hike in the next Fed meeting. 1%. Might not sound like much to some, but believe me, it is. And some Fed officials, including the likes of Raphael Bostic, have not ruled out a 100 basis point hike either. It is looking increasingly likely. And plus, it's not like the Fed will be alone in making such a move. Yesterday, the Bank of Canada hiked its benchmark rate by a full 1% to reach a base rate of 2.5%. This is the largest rate hike in over 22 years for the Bank of Canada, and no amount of Tims and poutine is going to take the edge off that in a hurry. Even the Bank of England rattled the teacups with a 25 bip raise, with surely more to come soon. The only central bank that appears to be asleep at the wheel in regard to rate hikes is the ECB. More about that in my video from yesterday. So, will the Fed pump rates by a full 1%? Well, it all depends on the outlook for growth. As I mentioned in my video about a possible recession, it's pretty clear that we ought to be in one. If that is indeed the case, then the Fed could be more lenient on the rate hiking front. That's because they don't want to crush the economy too much. However, it seems from most of the overtures from the Fed that they still perceive the economy to be growing. It's baffling, I know. So it really is a hard one to read. The FOMC rate decision will come a day before the Q2 advanced GDP estimates break, so we can't speculate on that. However, you can bet that the Fed will have access to reams of data before the advanced GDP estimates come out. In the next few days, though, it's important for you to keep your ears to the ground when it comes to Fed overtures. They'll want to give the market forward guidance as to how they are going to approach the rate hikes and reduce the risk of nasty surprises. You'll also want to keep your eyes open to some of the most important economic indicators that are going to be breaking over the next week or so, indicators that could help to give an idea of growth. These include things like retail sales this Friday, jobless claims next Thursday, and S&P's PMI Flash Manufacturing Index next Friday. Now, when it comes to the impact on markets, it seems as if the crypto markets have rebounded from the initial dump. It also seems that the market has now priced in that 100 basis point number, at least the interest rate futures. However, if we do indeed see a 100 bips rise, I think it could still lead to a crash in the market. That's because it's still a pretty unprecedented move and signals the full severity of the economic maelstrom we find ourselves in. Now, perhaps it turns out that the growth picture is less than rosy, though, and the Fed subsequently decides to go easy on the markets. If it's less than expected, then this could turn out to be a boon for the markets, at least temporarily. But in the short to medium term, I still see so many headwinds. The crypto markets themselves also have unique challenges that are dragging us lower. For example, in addition to Voyager's bankruptcy yesterday, Celsius finally also entered Chapter 11. There's likely to be a lot of fallout from this, which will be felt by all. Then, of course, you have the Three Arrows Capital saga, which seems to be getting even more contentious by the day. But folks, whatever slings and arrows come our way, see what I did there, we will be keeping you up to speed on what's going on out there in the big, bad world.